Right. Well, good evening, everyone. I think we'll make a start. I apologise for the dings that's going on in the background. That's new people that are entering the meeting. My name's Ed. We're going to be together for about the next 45 minutes to give you some clearer idea of the actual cost of your sons and daughters going off to university, and what sort of part you can expect to be playing in it. There is going to be quite a lot of information. Don't panic about that. Don't worry too much about taking notes, because everything that we're going to talk about today is going to be available on a website, and that is the actual address of the website there. I'll show you that again at the end of the session. So you can pick up some notes on there. There is a sheet that you can print off as well. And if you miss any of this or your friends would like to see it, it is going to be recorded. And again, it will be available on the website, and I will pass that on to the school and they will have the address of that for you to actually look into. But if you go onto that website, you will be able to find it on there easily. So if you have any questions as we go through, unfortunately, I can't now see the chat box. So if you do have any questions, please feel free to unmute yourself and ask away. Don't wait for me to stop. If there's a question that's urgent, you just jump straight in and ask the question, and we go from there. So, okay, student finance, the real cost of going to university. This session is going to be sponsored by Saffron Building Society. They've been supporting schools in the area now for about the last 6 or 7 years. And without them, we couldn't do any of the stuff we're doing in local schools and the students as well. So many thanks to them. Okay, so your offspring will have two types of support. One is going to be repayable in the form of student loans. That comes from a company called the Student Loan Company. Please ignore that title. It's actually the government that will be paying for them. So it's a government-backed institution. Those loans, as I say, are repayable. The other type of support will be non-repayable, and they come in the form of grants, bursaries and scholarships. And we'll look at those towards the end of the session. But we're going to kick off to start with student loans. Now, the application process for students that will be starting university in September, October of this year, that began in around February, March of this year. There was a deadline of the 22nd of May, which the government put down for all applications for student finance to be in by that date. It's a bit of a scare date. Don't get too het up about it if that's been missed. That was the date that they said they would guarantee that monies would be in the account prior to the courses starting. However, they say there's only a 6-week turnaround. So to me, the maths doesn't work out. May the 22nd, 6 weeks on from there, certainly doesn't take us into September, October. So the actual truth of the matter is continue to apply. If they're slightly late and the money's a little bit late getting in, then the universities won't make too much of a fuss about that. But if they're going to be living in a flat, they may have a bit of a problem. So you might have to just sub them out for a short period of time until that money comes through. So obviously the better is to get it in early. If we've missed that deadline, which obviously we now have, don't panic too much because there is still plenty of time left. Now, the process for the application is all done online. There's no paper forms anymore. The student will go onto the Student Loan Company website and they will open up an account. That process will probably begin there in school, or it may have already begun in school. In fact, it may have already come home to you because you will be involved in that application process, because part of the application is going to be means tested. Your overall household income will have an effect on the amount of money that your sons and daughters can apply for. Now, even if they know that they're going to be doing a 3-year course or a 4-year course or even the 2-year sandwich course that's now available, it doesn't really matter because the application only lasts for 1 year alone. So provided your circumstances or their circumstances don't change, then the 2nd and 3rd year is just going to be a mouse click. If your circumstances do change, you must let your sons and daughters know, because that will have an influence on the amount of money they can borrow in the 2nd and subsequent years. So encourage them to keep that information up to date, but obviously you must let them know if you're going to be retiring, changing jobs, income's going to be changing, any sort of income at all. I'll explain more about that later on. You must keep them up to date. Okay, so the application's been made. Now we can think of our student loan in two portions. One portion will pay for tuition fees and another portion will pay for their living costs. Now, tuition fees have been frozen at a maximum for the last few years of £9,250. For this year, that's going to be the same again. That's a full-time course, a maximum of £9,250. If they decide to do an accelerated 2-year course, the maximum is £11,100. And if they decide to do part-time, then the maximum is £6,900. Now, they can shop around. There are courses cheaper than the maximum. What I encourage the students to do, though, is not just to look at the course cost for the tuition fees. That's a bit of a false economy, because by far and away the most expensive part of this entire process is going to be their living costs. That's the one that fluctuates the most. So whilst they might find a cheaper course somewhere in England, it might be in an expensive part of England, which puts the overall cost up quite a lot. So take this tuition fee course quite lightly. So don't go too crazy about finding the cheapest tuition fees that you possibly can. Now, if they do find a tuition fee course that is less than the maximum of 9,250 or 11,100 for the accelerated course, they can only borrow up to that figure. So if they find something for £8,500, they can't borrow more than £8,500 for their tuition fees. Now, even if they get a cheaper course and the university has had good results, the government may have given them something called TEF, Teaching Excellence Framework. It basically means that it's a very well accredited university with good results, and they have given them the ability then to raise their fees in line with inflation as measured by the retail price index every year until they hit the ceiling. So that ceiling currently, as I say, 9,250. That could change. There is nothing in stone to say that's always going to be the same. That could always change. If you could mute yourselves, please, ladies and gentlemen, unless you've got a question. Otherwise, we're getting quite a lot of feedback. Thank you. Right, that money will be paid directly to the university. It will not go through their bank account, and it's paid at a rate of a quarter at the beginning of the first term, a quarter at the beginning of the second, and half at the beginning of the third term. Now, the only way that your sons and daughters will realise that that money has gone out is if they go onto their student loan account and they will see a balance on there. And that will be from the day they start university. And from that very first day, their loan will start to accrue interest. And I'll tell you much more about the interest as we go through that particular portion of the chat. Any questions on where we stand at the moment on tuition fees? Very simple. Whatever they borrow, whatever the course of the tuition fees are, whatever the course cost is, that's the maximum they can borrow for those tuition fees. Advice is always borrow the maximum or apply to borrow the maximum. If they don't draw it down, they will not be charged for it. So much better to apply for the maximum. And then if they only need to draw £7,000 down or whatever that is, then they'll only be charged for the portion that they draw down. So don't panic about over extending, if you like, on the application. Right, if there's no questions on that, we will push on to the loans for living costs. Now, this is where they're living, where they're studying, and what your household income is, has a bearing on the amount of money they can borrow. A mixture of those three things will affect the amount that they can borrow. Now, not many students, by and large, choose to stay at home and study locally. And you're probably thinking, crikey, the quicker they move out, the better, and go away to university. Whether it's the students or whether it's the parents, the general consensus is that people want to move away and get a little feeling of independence. Now, if they do, however, decide to live at home, this is going to be by far and away the cheapest way to get their degree. And if budget really comes to budget, then this might be the only realistic option to get the degree. Now, as I go through these, I'm going to give you a high and a low, a maximum and a minimum. Bear in mind, these are the two outside amounts that your child will be able to borrow. The chances are it's going to be somewhere between those two limits, but I'd explain that right towards the end of this particular part of the session. Now, if they decide to live at home and study locally, they can apply for a maximum of up to £8,000 per year. And if it's a minimum, if circumstances dictate, the minimum that they will be granted will be just over £3,500 a year. Now, if you think about what their costs are going to be if they're living with you at home, you're paying the rent, you're paying the bills, you're probably going to be supplying a lot of the food. Out of their loan, they will need to get transportation, equipment, clothing, and a bit of socialising money. If they're already doing a bit of part-time work at home, then this is a very doable way of getting their degree. My experience is 95% of students would prefer to move away, but realistically, this may be the option that they have to go for if budgets are going to be tight. Okay, so if they are going to move away and they're going to be studying and living outside of London, then the amounts they can borrow are as follows. It will be a maximum of £9.5 grand and a minimum of 4,200. Those are the two extremes. Now, out of that, of course, they will now have to pay rent, bills, food, still travel, equipment, clothing, socialising money. Depending on where in the country they decide to live, this budget, even on a maximum, could be very, very tight. The cheapest halls of residence I've found, and normally rents and halls of residence fees go about hand in glove, it comes out to about £70 per week. The most expensive comes out to £420 per week, eye-watering, £1,600 a month for their rent at their university. Those are the two sort of extremes. Cheapest area that I've found, Huddersfield. Most expensive, central London. So this is what I meant about taking the thing holistically. Don't just look at the cost of the course, think about the overall cost of living as well in the area that they're looking to study. Now, if they decide to stay in London, study in London, live in London, then the amount they can borrow goes up to a maximum of 12,400 and a minimum of 6,800. Rents are going to be more expensive, traveling is going to be more expensive, socialising is going to be a lot more expensive if they decide to stay in London. So even with the maximum figures again, this could still be quite tight. Now, the first thing that I'm going to say now, which really directly affects you, if they are only granted a certain amount of money between the maximum and the minimum, there is a government expectation for you to top up whatever they're given to the maximum figures we were looking at earlier on. So, for example, if they are going to stay in London and they were only going to be able to borrow £8,000 a year for their living costs, then there is a government expectation that the balance, the 4,382 difference, is going to be made by a parental contribution. That may or may not be possible. All I'm saying is you need to be involved in that conversation with your children to make sure that they understand where you're coming from. You may not be in a position to pay that chunk of money to them. They need to understand that before they get too deep into a certain university that they may want to go to or not. So it has to be an overall decision being made. So let's just go through a summary of where we are from April this year. Living at home, maximum just under 8, minimum 3.5. Living and studying outside of London, maximum 9.5, minimum 4.2. Living and studying in London, maximum 12.4, minimum 6.8. That money will be paid directly into their bank accounts at a rate of 1/3 each term. That might well be the first time that they've ever had to manage a chunk of money over a period of time. And we do try to do some budgeting workshops with them so that they really understand how important it is to make sure that they prioritize their outgoings so that they're not going to go short on rent or food or something like that at the want of going down the pub maybe 6 times rather than 5 times a week, whatever that might be. Any questions on where we stand at the moment on living costs? Okay, so now I'm going to explain a little bit or show you a little bit about this change in costs in halls of residence in various parts of the country. Obviously, we're not covering everywhere, but this will give you a flavour for where we stand. So in London, the high cost just over £400 per week for a halls of residence. That's going to be for a single room. It's going to be a large room. The actual university is QMC for that particular thing, whereas the cheapest is £120 a week. That won't necessarily also be at QMC, but it might be. But those are the two extremes for living costs in halls of residence. You will probably have a fair idea of what rental costs might be in general, but student accommodation will be different, and it will also be something that they're probably going to share the cost of. But generally, it comes out to something very similar to what the halls of residence costs are. If we go to the other extreme, we're looking at £140 maximum for Huddersfield. That is going to be a single room again with an ensuite bathroom, shared kitchen, shared living accommodation as well. Whereas if we go to the low cost per week, that's almost certainly going to be a shared room, perhaps no ensuite bathroom. It might be a shared bathroom down the way. But there is something in there, hopefully, for all budgets. Okay, so all the way through, we've mentioned this maximum and minimum. Let me explain now what the difference is or what you have to do to get to the maximum and minimum. Now, I mentioned right at the beginning, where they're going to be studying, where they're going to be living has an impact on the amount they can borrow, as does household income. Let me explain to you now what is meant by household income. It's not just your salaries, it's any rental income you've got coming in, it's any pensions and benefits that are coming in, it's any rents that you might be getting in from property elsewhere, it's any interest on savings, it's any dividends on shares, it's basically everything that comes into the house gross before any tax. The only thing that doesn't really count towards household income will be maintenance payments that are being paid for children that's living in the house from an estranged parent. Everything else counts towards household income. Right, for your sons and daughters to get the maximum figures that we were speaking about earlier on, your household income needs to be less than £25,000 per year gross before any tax. For them to only get the minimum, if they are living and studying in London, your household income needs to be £70,000 or more. If they are outside of London but not living at home, then it's £60,000 or more. If there are more than one child living at home, so there's more dependents, could even be your mums and dads or whatever that might be, so there's more than that dependent at home, these figures will change, but not by a huge amount. So if you've got another son and daughter living at home, that might push that minimum figure from 25k up to 26 or 27k. Not a huge difference. Equally, the top line figure there as well will move up by £2,000 or £3,000, but again, not a huge difference. Okay, so what are the only other ways that they can take a little bit more out as a loan? Well, there's only 4 ways that I'm aware of. So certainly the first one, as you all know better than most, the first one isn't a particularly cost-effective way of having their own child. The cost of that far outweighs the benefits of borrowing more money from the government. So we'll move on. If they are a registered carer full-time or part-time, then they can borrow some more money. If they have particular difficulties, they can be learning difficulties, they could be physical difficulties, then they may be in line for a grant, but also they may be able to borrow some more money. I'll tell you a little bit more about the grant towards the end. And the only other way that I'm aware of is if they are already living on their own when it comes to the application process. Now, it could well be that the child has access to 2 different homes. So some period of time they might be living with mum, some period of time they might be living with dad. My advice, if that's the case, always put down the address as being the one with the cheapest household income. It means they can borrow more. But it will have to be the same on the electoral register. So the electoral register is king. But if you have a choice between the two, go for the one with the lowest household income. Okay, right. So what's this entire process going to cost? Well, I mentioned right at the very beginning, as soon as the money goes out, it starts to accrue interest. And you can think of the interest rate that they're going to be charged in two portions. They'll be charged an interest rate whilst they're at uni, and they'll be charged an interest rate which may well be different once they graduate. Whatever that interest is, though, it is going to be compounding. So they're not just going to be paying interest on what they borrow, they're going to be paying interest on interest as well. And the amount of interest they're going to be paying will have a relationship to inflation as measured by the retail price index. Now, currently, if they are at university, they will be paying 3% over RPI. Now, for the guys that are going to be starting this September, they already know what they're going to be paying for the first academic year that they are at university, because it's fixed every April, and it was fixed last month. RPI then was 1.5%, add 3% onto it. They will be paying 4.5% on their balance over the course of the first academic year they're at university. So what does that mean in real pounds? Well, there's a mean amount that students are probably going to be borrowing. It's somewhere between 40 and 50,000 pounds for a 3-year course. If we take the mean amount as being 45k, 4.5% on 45k comes out to 2 grand a year. So if they borrow the 45k, which is about the mean, then at the end of the first year, that's going to go up to 47, 49, 50 and a bit, because don't forget it's compounding. So you can expect it to be going up every single year. Right, what about then once they leave university? Well, now it becomes all a little bit less clear, because the amount of interest they're going to be paying now will depend not on how much they've borrowed, but on how much they are now earning. Now, I've got a figure down there of 27,295. I'm not going to sort of quote that figure too much at you. I'm going to call that the lower watershed figure, because that figure changes every single year. So by the time your guys graduate, it's going to be different from that figure. But for now, we'll talk about it as the lower watershed figure. If their earnings are less than the lower watershed figure, gross, they will only pay RPI on their outstanding balance for interest. If their earnings are anywhere between the lower watershed figure and the upper watershed figure, which currently is 49,130, then they'll pay RPI plus somewhere between 0 and 3%. And if they're earning more than the upper watershed figure, they'll be paying what they were paying whilst they were at university, which is RPI plus 3%. So currently RPI, as I've said already, is 1.5%. Last year it was running at 2.6. Next year, who knows? The chances are the downward pressure that we've seen on inflation because of COVID, that's going to work its way out of the system. So there's every chance next year they'll probably be paying a little bit more in interest than they are this year. Any questions on the interest element of the loan? Okay, so we'll push on. So repaying the loan. Now, repaying any normal loan, if you think about your car loan, you take out a car loan for 10 grand, you might have to pay £220 a month every single month to repay that loan. There's a fixed repayment schedule as soon as you take the loan out. If you take out a bigger loan, so you want a 20 grand car loan, your repayments go up because it's in proportion with the amount you borrow. Now, student finance doesn't work like that at all. The amount of loan that they have to repay every month depends on one thing and one thing alone, and it's nothing to do with the amount they borrow. It's solely to do with the amount of money that they're earning. If they are earning less than the lower watershed figure, then they will have to make no repayments at all. But bear in mind that the interest is still going to be applied to their loan every single year. But anything that they earn over the lower watershed figure, they will have to pay 9% of those earnings back to the student loan company every single year. So if they had a job that were paying them 37,295 gross, then they would be expected to repay £900 for that particular year back to the student loan company. Now, bear in mind that obviously they can pay more if they would like to. That is a complete choice, but they have to. This is a mandatory figure of 9%. Now, if they're working for an employer, the good news is the employer will do all of that for them. They have nothing to do at all. So their employer will deduct their income tax, their national insurance, and their student loan repayments. If they are self-employed, they will have to make sure they keep this money back in exactly the same way that they would do income tax or national insurance. And they would have to pay it in the same way as a lump sum by the end of the next tax year. If they fail to make that repayment, there will be a fine. If they continue to fail, the fine will get bigger and eventually it will go to court. If they decide to move abroad, unfortunately, whilst they might not pay UK income tax, they will have to pay a certain amount of student loan repayments. And the amount they will have to pay will depend on the country that they're working in. If it's an EU country, it will be basically the same rate as they would pay whilst they were in the UK. So convert the European earnings back into sterling, anything above 27,295, they have to pay that in the same way that they would have done if they were self-employed. If they are working in other countries, it might be that that figure is lower, could be as low as about £11,000, anything over that, they pay 9% back. If they're working in some countries, it could be higher than that, all just depends on the cost of living of that particular country. Okay, so if they take out this mean amount of 45k, if interest rates stay roughly where they are, and if they choose not to pay any extra back, it means that in order just to cover the interest that's accruing on their loan every year, they will need to be earning around £50,000 a year. That means that even if they are going into a really well-paid job once they graduate, they should expect to see their debt increasing in the short term until their earnings are more than about £50,000. And of course, that will go up should interest rates go up as well. So they are getting themselves into 45-ish thousand pounds worth of debt. Question in everyone's minds, theirs, yours, everybody's, is it worth it? Well, the University of Kent have done some sums on that and they've done some research on it. And their findings are that somebody that comes away with the right degree should expect to earn over the course of their career about £1 million more than somebody without that degree. So a £50,000 investment in themselves to earn £1 million more over the course of their career, 20-to-1 return, still a fantastic investment. And this is a relatively cheap loan. However, there's the caveat in there, if they come away with the right degree. So what's the right degree? Well, if we go back to the 1970s, about 8% of that age group were going on to uni. So any degree was a great degree. It got you in the top 10% of job picks. By the mid-90s, we were up to 28% of that age group going to uni. Employers had more choice. That meant that thirds were no longer really going to get you in the top 10% of job picks. Yeah, they would still get you in the top half, but certainly not in the top 10%. But we're now in 2021, 2024 by the time these guys are going to be leaving university. At that stage, probably around 60% of that age group will be going off to university, which means that 2-2s no longer really fulfill the criteria for the top 10% of job picks. So these guys need to be going to get a first or a 2-1 to get the plum jobs. Yes, a 2-2 is still going to put them certainly higher than a third, and a third will get them higher than nothing at all. But there are other options. There are apprenticeships options out there. There are all different types of things that might suit better if perhaps their mind isn't really focused on getting that first or 2-1. And we do, or I certainly do when I talk to students, hammer that message across. It's no point spending 45 grand on something if you're not going to make the most of it and come away with the best possible degree. Okay. So up until now, we've spoken about student loans. That was how this talk was sold to you. That's how I started it. Let's just look at what a loan is. It's a chunk of money that somebody gives you with an expectation of repayment. That certainly fulfills the criteria of the student loan. It has an interest rate or a coupon attached to it. Yes, it does, RPI plus 3%. But now the waters get very muddy, because any normal loan, the more you borrow, the more you repay, and you have to repay the same amount every month. This doesn't act like this. The amount you repay is solely down to how much you earn. So you pay 9% of earnings above the lower watershed figure if you borrowed 5 grand, and you pay 9% of earnings above the lower watershed figure if you borrowed 55 grand. So the amount of money you've borrowed has no impact at all on the amount of money you repay every month. And the other big way that this doesn't act like a normal loan is it does not affect their credit rating. And by not affecting their credit rating, it means it has no bearing at all on their ability to borrow money going forward in the way of a mortgage, a credit card, a car loan, Sky Telly, whatever that might be. It does not and cannot take into account their student debt. So I would argue this student loan is actually a complete misnomer. It's not a loan at all. What we're actually looking at here is a 9% student tax, and it's a 9% tax on their earnings above the lower watershed figure, currently at just over £27,000 and probably up towards 29 by the time these guys graduate. And if we think about it as a tax, it's a load easier to cope with mentally than it is worrying about what's my balance on my student loan, how much has it gone up by this month, can I actually afford to repay this thing? It should not dictate their life going forward. Nobody will know about their student debt other than them and the student loan company, and it does not affect their decisions going forward. So I think if we all think about it as a tax, it's going to be loads easier to actually come to terms with than worrying about this chunk of money. Okay, so when will it all end? Well, like any loan, it will end when it's all been repaid. That's the principal that's been borrowed plus the interest that's accrued. But here's the big thing, and this is the fifth way that it doesn't act like a loan. From the April after they graduate, add 30 years onto that, and whatever the balance is outstanding at that point is going to be wiped clean. Irrespective of the amount outstanding, it's going to be wiped out. So at the age of 51, they might have families, they might have credit card debts, mortgages, car loans, all sorts of debt, but they won't have student debt. And if that seems like they're a long way away, these two guys are both 51 and they look pretty good. So I don't think this is anything to panic about, ladies and gentlemen. I would really encourage, as long as they're actually committed to going off to uni to come back with his best degree, this is not scary finance. Okay, any questions on the student debt side of this thing before we move on to the nice bit, the bit that we don't have to repay? Okay, if you do think of any questions at a later date, you can always get hold of me through the website. You can always get hold of me through school as well. Don't be scared about giving me a ring or dropping me an email or a text. Absolutely fine. I'd be more than happy to answer any questions you've got. Okay, so I mentioned earlier on as well, disabled student allowance. If your sons and daughters have got some disabilities, these are figures, maximum figures that they could be given as a grant. So specialist equipment up to just under £6,000 for the whole course, non-medical helper up to £23,000 a year, and a general allowance of a couple of grand a year as well. Plus, they may well be able to borrow some extra money on top of that. Every single case is looked at individually. So these are the maximums. Not all everybody is going to get the maximum by any means. So everything is looked at on an individual basis. Okay, so we also mentioned right at the very beginning, going back half an hour or so ago, there were going to be some areas where they could borrow, not borrow, they could be given some money, non-repayable. The more of these they can get, the better it is. That's because that will then mean that they're going to come away with less debt than they would have otherwise. So if we start off with grants, now there are loads and loads of grants out there, and the grants are sums of money. Is there a question?
Thank you.
So sorry about that. Right, we'll go back. Grants are chunks of money that are given by companies, could be given by individuals, could be given by charities. The more grants that your sons and daughters can get, the lower the amount of money they're going to have to repay. They cannot be expected to find every single grant that they may be eligible for. So I'm going to give a small plug to an app that was designed by an 18-year-old Indian chap called Grant Fairy. Now, Grant Fairy is an app on a phone, costs about $2.99 a month. They will only need it for a few months. They put all of their details into it. Grant Fairy will then search for every single UK-based grant that they are eligible for. They then press another button and multiple applications go out to all of those grants. Saves loads and loads of legwork. Let me give you an idea of what I found on Grant Fairy. If any of you, when you were going off to uni, sang and you didn't go to Exeter University, you missed a trick, because if you sing in the choir at Exeter University for a given period of time, they'll give you 200 quid as a grant. Equally, if your name is McDonald and you went to one of the Scottish universities, you get a 50 quid grant from the McDonald Trust just for having the right surname. Why would you ever know that? No chance. So Grant Fairy, for me, I think is a worthwhile expense. Scholarships are given by the faculty of the university that your sons and daughters will be going to. There are some scholarships for low-income families, for artists, for sportsmen, for musicians, for every type of sort of background that these students have. Everybody can apply for a scholarship. Not that many people are going to get them, but there's no harm in asking. And the one that I do want to give a little warning about, and one that I do spell out to the students as well, bursaries. Now, we probably all realise the biggest bursary giver, which is a company that basically pays for your fees, over the last 70 years is the NHS. They gave a wide range of degrees, 100% bursaries for many, many, many years. The deal was that once you got your degree, you worked for the NHS for a fixed period of time. At the end of that time, you could go off and pursue whichever career that you wanted to do. Your debt back to the NHS was paid in time worked. If you wanted to buy yourself out before that period of time was over, you did it on a pro rata basis. It was all very, very fair. Sadly, with cuts, the amount of degrees that are covered now has narrowed. 100% bursaries no longer, now much, much lower as well. But what's happened is the private sector have come in. They have taken over. So the banks, the insurance companies, the accountancy firms, people like that. And they say, right, come and work for us aged 18. We will pay you a salary, but we will also put you through university in the same way as every other student. The difference being you're going to be paid a salary while you're there, so you'll come out with no debt. Looks a fantastic deal. Come out with no debt, job at the end of it. What's wrong? What could possibly not be there to love? Looks so good. I got a little bit concerned that maybe there's something behind that. So I made a couple of phone calls to two banks and I asked them about their bursary scheme, and it looked fine on paper. I got to the point whereby we were talking about buying yourself out on a pro rata basis in the same way you could do with the NHS. The phone went very quiet. The reason being that whilst you could buy yourself out, you couldn't do it on a pro rata basis. In fact, you had to repay every single penny that they had paid the student over that 3-year period in order to buy themselves out of the remaining period of time that they had to work in their contract. So finding 90 grand, 95 grand, maybe age 23, 24, although you've come away with no debt, you're looking now at having to stay with that company for a period of time. They are not necessarily all like that. All I'm saying is to you and to the students as well, ask loads of questions before you sign up for a bursary. What happens if I want to change before my time is out? Can I buy myself out of that? Is that going to be viable? If the answer is not, then maybe it's worth getting into some student debt for a period of time, which we know is going to be a maximum of 30 years, to keep your options open rather than it is just to seal the whole thing down. Okay, and the final thing I want to say tonight is a lot of people are now starting to think about apprenticeships as a different role to university. Absolutely, totally agree. I think apprenticeships can be an absolutely brilliant way forward. One thing I would say, the number of apprenticeships in general is going down currently over the last 5 years, but the degree level apprenticeships, which is the ones that we're actually putting against the universities, are going up almost exponentially. So at the moment, 10 people will go to uni, one person will get a uni degree apprenticeship equivalent. That is going to be changing. That balance is going to be changing over the next few years. So apprenticeships, when it comes to these high level apprenticeships, so that's at the sort of 7, 6, 5 level, 4 of these generally the sort of first year degree. So it's going to be a bit of a watered down degree, but 5, 6 and 7 could well be in line with a normal degree as well. Those are becoming much, much more popular than before. So right at the very bottom there, 515,000 university places in 2019 against 325,000 apprenticeship starts, with only 46,000 at the higher level. That number is changing and it's getting bigger and bigger. Post-COVID, we expect that to get even bigger as well. That's all I've got to say on this. If there's any questions, I'd love to take them now. If you prefer to write those, by all means do, but bear in mind I can't see the chat box. So you might have to do that with an email. But other than that, I'm going to leave you with the website where everything we've spoken about today is on. You can watch this whole thing again if you're really desperate for something to watch. And you can obviously contact me through there as well. So I'm more than happy to take any questions.
You, I'm off, but thanks for the talk, Ed Flack.
You're very welcome.
Okay, bye.
And if you don't have any questions and you need to go, that's absolutely fine. Please don't worry about going off.
Thank you. Well, we want to thank him. He was very, very good. Thank you.
You're very welcome. Thank you.
That was brilliant. Thank you very much.
You're welcome. I'll just leave that up there. You just drift off as and when you want. I'll leave the slide up there until you've all gone.
Thank you.
You're welcome. Bye.
Thanks.
Hi there. Is it worth paying? Is it worth paying off a student loan versus letting it run its full course?
I would suggest not, purely and simply because if you can actually use the money that you would have paid the loan off with in order to give them a start of getting a flat or a house or whatever, for me, that's a better way of using the money when I know that whatever debt they're going to have is going to be wiped clean in 30 years, and whatever balance they've got isn't going to make one iota of difference when it comes to their mortgage or any other loan they might want to take out. But it is absolutely a personal choice. If you feel more comfortable with them having no debt at the end of it, then of course that's absolutely fine. But it is going to be wiped out after 30 years.
Do you think interest rates could go up?
Yeah, over that course of time, there's absolutely no doubt that interest rates will go up at some point. Inflation almost certainly, I think, will go up this year. So come next April, we're probably going to be up around 2.5 or 2.75% for RPI again. So this is a cheap year. It will get a little bit more expensive, but again, it doesn't really matter how expensive it is if we know that whatever the debt is, principal plus interest, is still going to be wiped out in 30 years anyway.
Yeah.
Thank you.
You're very welcome. Okay, if there's no other questions, I'm going to wish everybody else a very nice evening, and hopefully we'll catch up in the not too distant future.